As of 2020, Poet Grain is now offering an accumulator contract. You've probably heard of these under the same or various names with some of our competition. These have been around for a long time. We are just now offering these as we really come to understand how they work and how those that we move these contracts through, how they manage them in the background. We really needed to understand the risk to us and you as a contracted party, and we now are ready to offer those, and we think particularly this year they're a very good contract to enter in. So let's get right on into how they work and why you should maybe consider them this year. We really think that forward contracting, what you're putting in the ground in spring of 2020, be it corn or beans, is pretty advisable this year. When you look at what USDA is thinking that will be planted this spring, 94 million acres, and if you apply any kind of yield that we've seen in the last 4 to 5 years, that gives you a carryout that is well over 2 billion bushels, and 2 billion bushels plus always is associated with a very cheap futures price. Be it an accumulator contract or an HTA or a market manager, any contracts where you can, secure a price early on is really advisable. So when we convert carryout to a price, we have enough history that shows that there's a high 90% correlation between carryout and price. When the USDA says that a carryout projection for a month is 2 billion, then we know that the price then gravitates to say 350. Or if it's 1.5 billion, we know the price then gravitates towards $4. So as the previous slide says, if we're going to be looking at something around 94 million acres and in a high 160s environment, you're looking at a price when we get to harvest and beyond of 2020 and 2021, that's associated with about a $3.50 price tag. Now, the great thing about an accumulator or any forward contract is that you are pricing against a December futures that is already substantially higher than cash, and you're also collecting a premium on top of that. So if you look at the black rectangle, the long rectangular box, right now accumulators are being priced in that range. And then if you look at the acres, even last year with our prevent planting, we still ended up with about 89.5 million acres planted and a yield of about 168. Well, you can see that this box, if you get priced anywhere in that could be relational to an 85 million acre complete disaster this year, or something down to as far as a 160 yield, which we haven't seen anything sub 160 since 2000 and I believe 13. So the great thing about an accumulator again is your pricing versus December, and you're also getting a premium on top of that. We're really putting you in a pricing point that requires a planting issue and a very poor yield to boot for that price to be realized later on. So let's talk about what an accumulator contract is and is not. An accumulator contract is not like going out and buying a futures or an options position on the Board of Trade. These are traded over the counter, meaning they stand on their own. They're a paper contract between two parties with agreed to terms. So the ADMs, the FC Stones, and who we use, Merex, they offer these products, and if you're interested in it, then we buy one for you and execute it as such. So with that being said, an accumulator contract can do things that a normal futures and options contract cannot. Now, the people that sell these products, they manage these contracts through use of futures and options that you're familiar with, but they're really managing the risk of those futures and options and not so much the price. So therefore, they're quite a bit different in that regard. So how does an accumulator work? Well, when you enroll in one of these contracts, you're receiving a premium price, let's say a 25-cent premium, to basically take on two obligations. The first obligation is if the market trades at or above that 425 at the expiration of the contract, you owe twice as many bushels at that 425. So if you sold 5,000, you now owe 10,000 at the 425. Both still a futures only contract. Both you can still roll, make alternate delivery points, just like a normal HTA. The second condition is what they call a knockout level. So let's say the market is $4 and you have a 370 knockout level. At 370, this contract ceases to price any more bushels at 425. At that time, the contract is concluded, and you have to then do something with the unpriced bushels. One thing you can do if you negotiate this at the onset of your contract is you can price the remainder at basically where the price was or close to that at the day that you put on the contract. So if you're getting 425 in a $4 market and you get knocked out at 370, then it would go and price whatever was left to be priced at $4. If you do not take that remainder option, then you will need to re-enroll bushels. You can re-enroll in another accumulator and basically at different levels to price the unremaining, or you can enroll them unremaining in any other product we offer, just like if you wanted to pick an HTA price at that point or do a flat price or whatever. A 5-cent one-time fee for all bushels in the program is charged at the onset, and you are not charged again to price or re-enroll any unpriced remaining bushels. So let's say you enroll in an accumulator contract. How easy is it going to be to know what exactly it is you have? Well, when you enroll in one of these, we're going to send you a confirmation that looks just like this, and it's going to define what the parameters are. In this case, you have an accumulation level of 424 with a knockout of 370. You've got 5,000 bushels enrolled. You have a maximum obligation of 10,000 should we trade above that 424, and it's daily going to price 24 bushels at 424 so long as the futures trade above 370 price. So in this case, you can see that the 424 that you're getting priced out daily is a price that is above and beyond where the futures price has traded since August of 19. So you truly are getting a premium and above any kind of current market value. Once a month, we will send you confirmation of your contract performance. So in this case, and this is one that just got put on recently, we've had 3 days traded where we've priced 24 bushels a day at 428. So it shows where we are, where your knockout levels are, and that you've had 72 bushels in total priced at 428, and there's 205 days left to price. So each month you will know where this contract is trading at and what you have accumulated so far. Again, it's important to remind you of what happens when the knockout level is reached. If the market goes at or below your knockout level, then you stop pricing bushels at that premium level. You still owe us for unpriced bushels, but you will have to either re-enroll those unpriced into another accumulator at a different premium price and a different knockout level, or you can price those using some other contract that we offer. Regardless, it's the one-time 5-cent fee for the whole program. So every day we could be looking at a different or a variety of accumulation levels or premiums that you could capture, as well as the knockout levels where you might be knocked out of this program. The options market gives us an indication of where those values should be traded or what you should consider. The little blue dots are where the current futures market is, and at the end of each line, it's where the market thinks that the contract can trade to above or below the current market. And that is based on the value of all options. So we know that all options, well, not all, but about 80% or more expire worthless. So the market's saying that they believe that there's 80% certainty that the market will not trade above or below the values on this chart. So when you select a accumulation level or take a premium and or select a knockout level, you have to be realistic on what kind of level that you want to select. If your knockout level is too high, you're most assuredly going to get knocked out before it's done. If your premium is too high, then that's not realistic either. So we use this tool to try to find a premium that is realistic and that will get us down the road. So here's an accumulator contract with some realistic parameters. It also includes the remainder function. So here we've got an accumulation level that's approximately 420, the green line. The knockout level is 350, the blue line. The knockout level is fairly low. So that's going to assure that we get priced about every day at 420. And we also have a remainder feature at $4. So if we would fall below the 350 level, whatever's unpriced would then be priced at the $4, which was just about a nickel below the price when we executed this contract. Yet every day we are pricing at roughly a 15-cent premium to the level that was trading the day we entered into the contract, and it's also at the level that's just below the contract highs that were in June of 19 so far. So this is a contract that looks like it's got high odds for pricing at a premium to a market that's pretty range bound at the moment. So this should get you a nice premium at the end of the pricing period with not a lot of worries. If you've got some questions about the accumulator contract or think it's something you might have interest in, feel free to call us toll free 866-385-2729. Ask for Cole, Tracy, or Matt. Thank you.